how Canada's energy giant fell into a 100-kilometer accounting black hole. In the gleaming towers of downtown Calgary, where oil and gas fortunes have been made and lost for generations, sits the headquarters of ENMAX Corporation, one of Canada's largest municipal utilities. For over a century, this company had been the trusted keeper of Alberta's electrical grid, powering homes and businesses across the province with the reliability that Canadians had come to expect. But between 2019 and 2021, something went terribly wrong behind those corporate walls. What appeared to be a stable, government-owned utility was actually concealing one of the most sophisticated accounting frauds in Canadian corporate history. A web of financial manipulation that would ultimately expose a $100 million black hole in the company's books. The story begins with ENMAX's ambitious expansion beyond its traditional utility business in the mid-2010s. Like many energy companies during the commodity boom, ENMAX's leadership believed they could diversify into new markets and generate extraordinary returns for their sole shareholder, the city of Calgary. Under the direction of CEO Gianna Mans, who had joined the company in 2016 with a mandate to modernize and expand operations, ENMAX began making aggressive investments in renewable energy projects, technology startups, and international ventures. The company established ENMAX Energy, a competitive retail arm, and ENMAX Power, focused on generation assets while maintaining ENMAX Distribution as their regulated utility business. These investments were marketed to the city and ratepayers as forward-thinking moves that would position ENMAX as a leader in Canada's evolving energy landscape. What wasn't disclosed was how badly these ventures were performing, or the lengths to which executives would go to hide their failures. The first red flags emerged in early 2019 when ENMAX's internal audit team began questioning discrepancies in the company's quarterly financial reports. According to sources familiar with the investigation, the auditors discovered that several major investments, including a $50 million stake in a wind energy project in Saskatchewan and a $30 million investment in energy trading software, were showing virtually no returns, despite optimistic projections that had been presented to the board of directors. Even more troubling was the discovery that these investments had been structured through a complex web of subsidiaries and partnerships that made it nearly impossible to track their actual performance. Chief Financial Officer Sheldon Fulton, who had been with the company for over a decade, allegedly began working with a small group of senior executives to restructure these investments in ways that would minimize their apparent impact on ENMAX's consolidated financial statements. The scheme that investigators would later uncover was both elegant and audacious in its complexity. Rather than writing down the failed investments as losses, which would have required disclosure to both the City of Calgary and provincial regulators, the executives allegedly created a series of accounting maneuvers designed to push the losses into future reporting periods while simultaneously inflating current revenues. They established what they called strategic reserve accounts that were ostensibly designed to fund future investments, but were actually being used to absorb losses from existing ventures. Money was moved between ENMAX's regulated and unregulated business units in ways that obscured which operations were actually profitable and which were bleeding cash. Perhaps most egregiously, the company began recognizing revenue from long-term power purchase agreements years before the electricity was actually delivered, a practice that violated both Canadian accounting standards and the company's own internal policies. The manipulation became more desperate as 2020 progressed and the COVID-19 pandemic put additional pressure on the company's finances. With commercial electricity demand plummeting as businesses shut down across Alberta, ENMAX's core utility business was generating significantly less revenue than projected. Rather than acknowledging these challenges publicly, executives allegedly doubled down on their accounting gimmicks. They began recognizing paper gains from the theoretical appreciation of their renewable energy assets, despite having no plans to sell these investments. They restructured debt arrangements to move interest payments into later reporting periods, temporarily improving their cash flow statements. Most audaciously, they allegedly began counting government subsidies and tax credits that they had applied for but not yet received as current income, inflating their reported revenues by tens of millions of dollars. The house of cards began to collapse in late 2020, when ENMAX's external auditors, Ernst & Young, began their year-end review process. According to regulatory filings, the auditors immediately identified several accounting treatments that appeared to violate Canadian generally accepted accounting principles. When they requested supporting documentation for various transactions, they allegedly discovered that many of the deals existed primarily on paper, with little evidence of actual economic activity. The wind energy project in Saskatchewan, for example, had been delayed by environmental reviews and permitting issues, meaning that ENMAX's $50 million investment was essentially dormant. The energy trading software had been implemented but was performing far below expectations, generating only a fraction of the projected revenues that had been used to justify its massive cost. As the investigation deepened throughout 2021, the true scope of the fraud became apparent. Investigators discovered that ENMAX executives had allegedly hidden approximately $100 million in losses through their various accounting schemes, representing nearly 10% of the company's total assets. The losses were spread across multiple business units and investment categories, making them difficult to detect through routine oversight processes. Even more damaging was the revelation that several senior executives had received performance bonuses based on the artificially inflated financial results, essentially profiting from their own fraudulent activities. Chief Executive Officer Gianna Manes had received over $2 million in bonuses and stock options during the period in question, while Chief Financial Officer Sheldon Fulton had collected an additional $1.5 million in performance-based compensation. The scandal sent shockwaves through Calgary's business community and raised serious questions about the oversight of municipal corporations across Canada. The city of Calgary, as ENMAX's sole shareholder, had apparently failed to detect the massive fraud despite having representatives on the company's board of directors and receiving regular financial updates. Mayor Naheed Nenshi publicly expressed his outrage at the deception, noting that the hidden losses represented money that could have been used to reduce electricity rates for Calgary residents or fund municipal infrastructure projects. The Alberta Utilities Commission launched its own investigation into whether the fraud had affected electricity rates charged to consumers, while the Alberta Securities Commission began examining whether any securities laws had been violated in connection with ENMAX's bond offerings during the period in question. The legal and financial consequences of the scandal continue to reverberate years later. Gianna Manes resigned as CEO in March 2021. Followed shortly thereafter by Sheldon Fulton and 3 other senior executives. The company was forced to restate 3 years of financial results, ultimately acknowledging over $90 million in previously hidden losses and writing down an additional $30 million in overvalued assets. ENMAX paid substantial penalties to multiple regulatory agencies and agreed to implement enhanced oversight and reporting procedures designed to prevent future fraud. The City of Calgary commissioned an independent review of its oversight procedures for municipal corporations and implemented new governance requirements for all city-owned entities. Perhaps most significantly, ENMAX ratepayers ultimately bore much of the cost of the fraud through higher electricity rates, as the company was forced to recover its losses through its regulated utility operations. The scandal stands as a stark reminder that even trusted, government-owned utilities are susceptible to the same corporate fraud schemes that have plagued private companies, and that effective oversight requires constant vigilance from regulators, shareholders, and the public. In an industry built on reliability and public trust, ENMAX's executives chose deception over transparency, leaving ratepayers and taxpayers to clean up the wreckage of their ambitions. The ENMAX fraud case ultimately exposed critical weaknesses in how Canada oversees its municipal utilities and highlighted the risks that arise when public companies venture beyond their core competencies in pursuit of higher returns. The $100 million accounting black hole didn't emerge overnight, but was the result of years of poor investment decisions, compounded by increasingly desperate attempts to hide the consequences from stakeholders. For the executives involved, what likely began as an attempt to buy time and turn around failing investments evolved into a systematic fraud that enriched them personally while imposing massive costs on the communities they were supposed to serve. The case serves as a cautionary tale about the importance of transparency, accountability, and effective oversight in protecting public assets and maintaining trust in Canada's essential infrastructure companies.